Owning dividend stocks can be a phenomenal way to beat the market and meet your investing needs. If you're looking for cash flow, you're looking for a little bit lower risk investment, typically companies that are paying dividends are a little bit more established. So they're going to have consistent cash flow. They're going to be able to say, okay, we're going to be able to pay a dividend for the foreseeable future because no company wants to cut their dividend. So I wanted to go through 5 dividend stocks that I love today. I don't own many of these in the asymmetric portfolio, but I do own a couple of dividend stocks because I think their potential to grow that dividend is really high long term. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And don't forget to check out my Asymmetric Investing newsletter. There's a link on the screen and a link in the show notes. You can follow everything I'm buying every single month in the asymmetric portfolio. And you get all of my analysis as well, at least 4 emails per week for premium subscribers there. So please join that community. And thanks to this video sponsor, Fiscal AI. If you go to fiscal.ai/ASYM, you can try out Fiscal AI for free. I'm going to show that throughout this video. And if you like what you see, you can get 15% off with that link. So phenomenal research tool. They've got all the financial information that you need, investor relations information, presentations, transcripts, insider buys, and I love their KPIs. I'm going to get to those in just a second, show you exactly what I mean. But check out Fiscal AI if you want to up your research game. Let's start with the first stock on the list. That is Alphabet. Alphabet isn't really known as a dividend stock, and it only pays about a 0.5% dividend yield, but this is the kind of dividend yield that could grow significantly over time. They actually could be paying about a 5% dividend yield today if they wanted to. But let's dig through some of the numbers. Alphabet, already one of the biggest companies in the world, $2.25 trillion market cap, and you can see here this dividend yield is just 0.5%. But solid growth over the last 10 years, 18.2% compound annual growth rate. So let's dig into some of their key performance indicators. The first thing I want to look at is just their business segments. This is all their business segments. And you know, search, that's in blue. That's obviously their biggest business, $202.6 billion in revenue over the past 12 months. And that has a compound annual growth rate over the past decade of about 16%. So solid growth there. But you're seeing much more growth in YouTube. The orange segment is YouTube, but this is just YouTube ads, keep in mind. They actually put their YouTube subscriptions in the green segment here, subscriptions, platforms, and devices. So a little bit confusing the way that they report that. I wish they would break that out, tell us exactly how much revenue YouTube is making and how much operating income it's making as well, but they don't. They do include the ads revenue, and you can see that's growing at a compound rate of about 23%. More recently, it's growing about at the same rate as search. Then you have subscriptions, platforms, and devices that I talked about earlier. That's going to be the hardware for Android phones. It's going to be the Android platform, the Play Store. There's subscriptions if you have a Google account, all kinds of things in there. I think there's going to be a lot of growth here from the Android system and then also from artificial intelligence. Those subscriptions are going to fall into this category as well. So 20% compound annual growth rate. I think that will continue. And the Google Cloud revenue continues to just grow like crazy. This is actually growing at about a 30% growth rate right now, but 40% since 2017. So that is a business that could be worth $500 billion, $1 trillion a decade from now. So that's a business that I think investors are still underestimating just how much growth potential there is there. What this doesn't really include is some of the smaller businesses like Waymo. Waymo could be a very, very profitable business for Alphabet long term, but it's not really broken out in the numbers yet. So for now, from a dividend perspective, we're just looking at the headline numbers, but let's look at some cash flows. And there's a couple of things that I want to look at with cash flows. First, in blue, and I'll actually change this so we can see this a little bit better. In blue, the cash from operations is going to be kind of the key for a business. What is the actual business generating in cash? That's what you're going to get from this number. So $132.6 billion worth of cash generated from operations. Why is there a big gap between that and free cash flow, about $75 billion? Because Alphabet is spending a ton of money building out infrastructure for artificial intelligence right now. So that's where they're seeing the upside, spending about $75 billion this year, I think is still the number for their CapEx to build out that infrastructure. So investing in the future, but you still have plenty of free cash flow left over to pay the dividend. And what you want to look at is the ratio between how much they're paying a dividend and what the free cash flow number is. So based on these numbers, you can see that Alphabet could increase their dividend by about 7 or 8x and still have a little bit of cash flow left over to invest into the business. And that's even after investing into capital expenditures. So that's that payout ratio. Payout ratio is typically based on net income, not free cash flow. But you want to compare what is the dividend paid? What's the total amount of dividends being paid per year compared to net income or cash flow to see if that's sustainable. A lot of times what companies will do, especially companies that have been paying dividends for a really long time, is they'll actually go and take out debt to pay that dividend. That's not what you want to have from a dividend growth business. So Alphabet, really low yield today, but great potential to grow that dividend long term. Target is my second stock. This is a little bit more of a traditional dividend play because you get a dividend yield of 4.7%. But what I want to highlight here is just how stable the business. If you look out over a long period of time, Target is actually a pretty solid growth business. Compound annual growth rate of nearly 4% is actually faster than Walmart over the past 10 years. I think that would catch a lot of investors off guard. But you can see where they've struggled over the past couple of years is kind of absorbing the growth that they got during the pandemic, during 2020, 2021, 2022. Just phenomenal growth as they leaned into things like Drive Up, Pickup, and then their ship delivery service. Those were obviously very successful, but they're kind of coming back down to earth as some of those services are proliferated amongst other companies, but you still have solid cash flow. Let's take away this revenue here, and you can see that net income in blue and cash flow in orange continue to be really solid. You have some aberrations here from both net income and free cash flow in 2023. This is when they were adjusting to some of the changes after the pandemic, basically ordered the wrong products and had them in the store and had to write down a lot of that inventory. But things are kind of back to normal. And again, if we compare free cash flow to the dividends paid, there's a nice coverage ratio here. $2 billion in dividends paid. Free cash flow is $3.5 billion over the trailing 12 months. So solid business, solid free cash flow. If you're going to get a 4 or 5% dividend yield, you're typically not going to get a company that's going to be growing 10, 20, 30% per year. So you're just going to be looking at, is this a stable business that's going to be able to pay this dividend over time and maybe grow it a little bit over time? I think that's what you're getting with Target. If we go back to just the overall metrics, price earnings multiple of 11, that's pretty attractive. Price to free cash flow, 13.3. That's what you want to see from a nice dividend stock. And I think in the retail space, Target is actually still pretty well positioned. They do have ebbs and flows, and likely more ebbs and flows than you get from a lot of other retailers. But long term, they have that urban positioning in a lot of cities around the US, solid free cash flow, solid revenue and profits coming from each of their stores. So I do like this dividend stock long term. I think you can just kind of set it and forget it at this valuation. VICI Properties is one of the REITs that I like, in part because I think you need to understand the business behind the REIT. So not just the REIT itself, but who's actually paying the rent for the REIT. And this is a gaming company, so I follow a lot of gaming companies. And in Las Vegas, things are going pretty well right now. Even the regional resorts doing relatively well, generating free cash flow. I'll get to some of those numbers in just a second. But you can see that the dividend yield, 5.5%. And I think that is just something that we can steadily count on. They do have escalators for most of their rents from companies like Caesars and also MGM Resorts. So let's get to exactly how good things are in Las Vegas right now. This is MGM Resorts. And again, the reason that I'm looking here is because MGM is the one that's paying rent to VICI. So if VICI is going to have problems paying their dividend yield to investors, it's because companies like MGM get in trouble. But that's not really going to be the case, because most of these properties, when they were signing long-term 20, 30-year leases, were in this time frame right here. So their revenue on the Las Vegas Strip has actually jumped since the pandemic ended to significantly higher than we saw pre-pandemic. That's been good for MGM's business, but it also means that the coverage ratio, the amount of cash flow that MGM has to pay their rent, has gone up, and that's good for VICI Properties. So VICI's had significant growth. That's because they've acquired a lot of resorts and casinos around the US, but they also got positive free cash flow from operations. So they're going to be able to be flexible with that. Do they want to buy more properties? Do they want to pay down some of their debt? And then obviously they're going to be paying that dividend. So that dividend yield of 5.5%, just a really nice yield to own in the REIT space. And I think you get a pretty solid business behind it in the gaming business. Another one that falls in a similar category is Brookfield Renewable Corporation. This is BEPC. There's also BEP. If you are in the US, BEPC probably fits your portfolio a little bit better because of the tax rules. But a dividend yield, 4.5%. What this company does is they own renewable energy assets. They started as primarily a hydro asset owner and then moved in solar and also wind. A lot of that with the Terraform acquisition that they made. Gosh, that was probably almost a decade ago at this point. But they're going to own those assets. They have a little bit of debt behind it. And then there's long-term contracted cash flow to pay that utilities pay for the electricity coming from those power plants. So you basically know what the cash flows are going to be over a long period of time. and then you're going to pay the excess in the form of a dividend. So that's exactly what you're getting from Brookfield Renewable Corporation. The way that cash flows and debt work is a little bit wonky with this business, but you can see that revenue is rising consistently over time. They periodically use stock to acquire more assets, but that's not something that's really core to their business. They're going to try to grow more organically than a lot of their competitors. And they do have positive cash from operations. That's ultimately what's going to make its way to that 4.5% dividend yield. The final one is Vail Resorts. Vail Resorts is one of the biggest moats that we have in the market. They're not making more mountains. This is a company that controls some of the best ski properties and mountain properties in the world. And they're just consistently growing the business over the past 10 years. There's an 8% increase in their revenue. That's on a compound annual growth rate. Dividend yield currently 5.9%. And what really intrigued me is this is a stock that was pretty expensive not all that long ago. But you can see shares have fallen pretty dramatically, about a 55% drop in shares since late in 2021. And that means that we're going from a stock that was really expensive at 40 times earnings or so to about 20 times earnings and a pretty good dividend yield. So let's dig into some of the numbers. Revenue is steadily growing. Cash from operations, a little bit volatile. It's what you would expect from a business that's going to be pretty dependent on the economy. You can see things are down pretty big in 2020. But pretty consistent business. And so that's going to be a pretty consistent cash flow to ultimately pay that dividend. Let's look at their segments here. Mountain revenue is still a vast majority of this business. This is going to be things like lift tickets, all the things you're going to do at the mountain. If you go skiing or even go in the summer, it can be pretty expensive. And you can see that's where they're making a vast majority of their revenue. Lodging revenue is going to be significantly lower. They've actually sold a lot of their real estate. That's the other segment here that you can hardly see real estate revenue. Pretty small right now. So they're not doing the same kind of big developments that they were a handful of years ago. So that real estate opportunity, so the last two segments that I talked about, a little bit smaller than it was. So they've squeezed more and more out of the mountain revenue. You've maybe seen that if you've gone skiing recently, long lines, high prices. So there's a lot of opportunity to make that experience better and I think ultimately grow the business long term. But in the meantime, you're getting a really solid business. Like I said, a really big moat. Even people have been complaining about the price of lift tickets for decades. I've been skiing for more than 30 years. It's always been a very expensive hobby. And now you're getting a wide moat business for about 20 times earnings and a really solid dividend yield of 5.9%. So I think that's a great yield to have given the size of the moat of that business. And I think potential opportunities for growth in the future if they can optimize that business a little bit better and bring a little bit better experience to users as well. So that's 5 dividend stocks that I really like today. I own one of those, Alphabet, in the Asymmetric portfolio. If you want more from that portfolio, check out asymmetric-investing.com and get everything that I am buying every single month there. And of course, if you like what you see here, check out Fiscal AI, fiscal.ai/ASYM. Thanks for watching, everybody. See you here next time.